Welcome. I am here with the co-founder and CEO at Workbox Company. He is sitting in Chicago, but if you're watching us on YouTube, he has a background of their soon to open, or is it open? It's open.
It's a week old.
Okay, the newborn Minneapolis location. So thank you for taking time out. I'm sure you guys have a lot going on, and for sharing your story.
Of course. Happy to be here, Jamie.
Okay, so give us the background. You have kind of a real estate, but investment, Brookfield. Yeah. So tell us a little bit about your background and then why co-working and flex.
Sure. So background, real estate investments, and mostly on the listed side for almost 20 years before starting Workbox. Most recently, I spent about 3.5 years at Brookfield Asset Management, helping to run their global listed real estate fund. Prior to that, 10 years at LaSalle Investment Management. So I was based in Hong Kong for about 2.5 years, helping to run their Asia Pacific practice. I helped build their European practice out of Amsterdam for 5 years, and then various sell and buy side roles in the US. So, I looked at basically every property sector, and really saw an opportunity in co-working, and decided to take the leap and leave a comfortable living to start a business with zero revenue in June 2019, and really haven't looked back since.
So June of 2019. Why? So what was it about the sector in 2019 that you thought, I want to do this? And I want to go from, I'm guessing your role was like heavy spreadsheets, analytical. I want to operate something.
The joke that I make is, if I spent one more moment staring at my Bloomberg terminal, that Michael Bloomberg was going to own my soul, and I just had to escape. Yes, very different than running an operation or operating business. But I saw an opportunity. I think truly looked at the whole sector, all different property types. WeWork was kind of my motivation. There was a lot of press about their expansion and just how sustainable that could be. And having covered the hotel sector as well, I thought, why not incorporate the hotel model in corporate or in commercial office, and manage and share economics with landlords, because that seemed way more sustainable, and just mutually beneficial with landlords. And that was really the reason that I kind of got into the space. The other reason I thought we could improve on the existing co-working offering was I still feel that the operators are really focused on the actual space. And my view was always, real estate was a commodity, and you had to provide something a little bit more than just space, because otherwise it's a race to the bottom and who can ever charge the lowest price. And it becomes the airline industry. What's the difference between Delta and American and United? It's really convenience and price. And we didn't want to make that same mistake in co-working. So my background was in investments. I felt I could add value if we focused on early and growth stage companies and help them get funding, help them provide advising and operational services to help them scale their business. And that would be differentiated enough that we wouldn't get in a price war, and that we would be apples to oranges to kind of our peers. And at the time, WeWork was really dominating the headlines.
Yeah, I mean, it's been an interesting kind of evolution, because the sort of executive suite model was very space and density focused, right?
Yep.
And existed for a long time and was quietly profitable. And then sort of the co-working model took over. And I was having this discussion with someone I interviewed yesterday, like not super focused on profitability in lots of cases, right? Like just swung to the, like, we're all about people, but a lot of times just got the model wrong, and, not enough density, not enough, just the revenue wasn't there. Yeah. So it sounds like you're kind of shooting down the middle to kind of get the maybe the real estate model right, and, be really attractive. So what's the story that your team tells when someone comes in for a tour? Like, who are you best for?
Yeah, so we're focused on early and growth stage companies. I mean, they range from anywhere from 3 individuals to 50 individuals. A lot of our companies have outside financing or are looking to raise outsized capital. But, we're not just growth stage companies in our portfolio. Because we're founder based, because there's a lot of executives that sit in our spaces, we attract nonprofits that want their team to cross pollinate with innovative businesses.
Yeah.
We attract a lot of services companies that see the benefit of business development by being able to access decision makers. So our core focus is early and growth stage companies and providing them all the resources they need to be successful. But because of that, we attract a lot of other kind of ancillary businesses that want to be part of that, innovative community.
What does your team look like? Yeah, like location based, and you mentioned a lot of your executive team works in the space. What is that? Who who's on the team?
So we are not remote. We're in the office business. So I was the least popular person in Chicago when I made everyone come back in June 2020. But we are providing space to companies, and it's important that we understand our business well and be part of that. We have about 25 individuals in the organization. Our strategy has kind of been filling vertical leads. So we have a COO and a CFO, a head of venture, a head of services, a head of marketing, a head of technology. And really, as the need rises, we start filling in support resources below that. And then we have a sales team of roughly 5 people, a whole operations team that's really the engine of what we're trying to provide as a service. So that's kind of how we're set up. We've almost got all of our corporate level hires done. There's a few individuals that we'll be bringing on next year, but for the most part, we're focused on sales and operational investment as we start to grow, as well as business services, which is our differentiator.
So what are those business services? So if I'm a member, what can I access?
Yeah, so kind of included with everybody's membership, there's access to all of our kind of vetted partners. So we have partners that help with digital marketing or bookkeeping or tech development or recruitment. And those partners they're vetted, they pay to have access to our members, and they're great resources for all of our members that need help with something, or who should I reach out to if I need to build that aspect of the business. In addition to that, all members get access to our kind of programming, which is monthly. We do Ask Me Anythings with venture partners or with, founders that have built something. And that's helpful to some of our early and growth stage companies, but that's, helpful to a lot of people. And I think it just creates a real community and a real connection. I think that it was important for us to kind of plug those services into, people that are just looking, to have an office, but want a community. So, yes, we offer community engagement through, happy hours and things like that, but we also wanted to make our community, wider through kind of our whole platform. In addition to that, we have an accelerator, which is an additional fee. That's an 8-week program where companies that are kind of, pre-seed, seed, get help training, sales, coming to market, things like that. After you graduate the accelerator program, you have access to over 40 angel and VC investment partners on our platform. We also have our own venture arm, Workbox Ventures, that those individuals get access to, as well as a whole list of, mentors and advisors that can help these companies, make the connections they need to be successful.
Okay, this might be a tricky question, but 1871 has a huge presence in Chicago. So they showed up when they launched like right after I opened, and I just remember being like, woof. I mean, they were like the place to be.
Yeah.
Everybody was there. Has that shifted, or do you just feel like you have something different to offer and like slightly different?
Yeah. I think, yes, I think we offer something different than 1871. I think their mission is to kind of attract new companies to Chicago. And I think that that's a wonderful thing and something that benefits the entire city of Chicago. As 1871's business model has evolved, they've gotten more into educational programming for
Yep.
very, very, very early stage companies
Okay.
and have done more kind of event space. But we don't really see them as competition. The companies that we're looking at going after are a little bit later stage.
Okay.
We obviously have the venture component. We're for profit, they're non for profit. So we see them as an ally of
Yeah.
Chicago, but not necessarily competition.
Yeah. Got it. Yeah. I mean, they're a great component of the ecosystem. I mean, I was in Chicago for 15 years.
Yeah.
And things like really shifted right around that time because Chicago was not really known for tech. And then kind of all of a sudden it was, which was
Yeah.
cool. Obviously you're kind of playing that role. So the business services and the folks on the platform, do they kind of cross state lines as you expand, or do you recruit?
Yeah. So we have virtual business service members, that are international.
Okay.
When, the pandemic hit in early 2020, that was our growth engine. So, initially we were thinking about, having our location and doing all of this programming in person. And then, the early period of the pandemic, we were like, how are we going to keep everyone engaged when they can't actually access a physical address? So we, like mad people, tried to build out this virtual network, where we're providing the same resources, but we were doing it over Zoom and over our virtual platform. And, had a lot of success retaining customers and even kind of growing virtual interest. So, we grew. We're one of the only flex operators to grow revenue 2x in 2020, and that really was largely driven by our business services. And that allowed us to be front-footed too. So, when everybody else was closing spaces, we became more aggressive acquiring spaces in early 2021. And just really glad that we did that. I mean, it's helped us build our footprint. We've been able to do partnership deals. I think when we started the business, in 19 and I was raising initial kind of pre-seed capital, the big pushback was like, hey, this model's brilliant. It makes a ton of sense, asset light, shared economics. Everyone's going to love this, but how are you going to get a landlord on board with this? Because they're used to doing the same thing, for 50 years. And the pandemic has really forced everyone to get creative. In a lot of ways, from a demand side, the pandemic has really accelerated hybrid work, which is benefit to co-working. But on the supply side, it's brought a lot of opportunities to work with new landlords as they try to problem solve themselves for, what this new world looks like post-pandemic.
So was your first deal in 2019 like a creative deal structure with the landlord, or was it a lease?
No, our first deal was a lease. I couldn't get anyone to buy into our operating capabilities until we actually had a business. But we worked with the local landlords here, and they didn't even give us TI dollars. So we had a defaulted advertising agency that was built out, that was almost dense enough to be co-working. We spruced it up, and that space today is 100% full or 95% full. So, from a density, from an aesthetic standpoint, certainly isn't the most competitive space in the submarket. But I think what we're creating in the community that we've created has made that a success. And we're not only bookend, we're kind of there on 3 blocks. We're surrounded by much larger, better capitalized WeWorks, and we are completely full. That was the first location. Our second location was an ex-Industrious that we took over. We took over another Industrious in the West Loop. We did a new development in partnership with Urban Innovations, and really our strategy kind of over the next year or so is to kind of continue to take over underperforming operators and helping to drive returns, leveraging our differentiation in partnership with landlords.
That's super interesting. So I always am like skeptical of the ability to take over underperformers, because I think usually they're underperforming because they just got the build out wrong mostly.
Yep.
So do you have to fix the build out? Like, is it, or do you kind of take the space as is, but overlay your platform?
So we definitely are aware of the build outs that will work and won't work. And we know our business model, we know our customers.
Yeah.
So we're not going to take over any space. But kind of our offering to landlords is, hey, we're not going to ask for any TI dollars. We're essentially going to rebrand this, and we're going to leverage on our different twist. And we think we can drive returns in excess of what operators would do if they were just selling space. You've built businesses yourself, and you're very familiar with real estate. So, the more dollars you put in, the faster and the higher the cash flows you need to come out.
Yeah.
And if a landlord is not putting any dollars in, I think that creates an environment where we can structure mutually beneficial terms. That being said, we're still trying to target 2x or 2.5x conventional lease returns on every deal we do.
Make no small plans.
Yeah.
Is the Minneapolis deal a lease, or is that a relationship with the landlord?
It's a partnership deal. So really all of the deals we're
going forward
now are not leases.
Got to do the first one. I have to say, there will be lots of people listening who you have the kind of background that maybe would convince a landlord you know what you're doing and might take a risk. And even you had to sign the lease. Yeah. I always tell people you're going to have to sign the lease the first time. And in Chicago, I had the personal guarantee. I had, all the things. I remember my husband being like, so are we going to live there if this work? Like, what are we doing? The personal guarantee in Chicago is just one of those markets where it's hard to get out of that. So, which is another advantage of the asset light relationship with the landlord. So, I presume you started in Chicago because that's where you live and you have a network. And
yeah, funny story. We felt pretty nomadic. My wife's from New York. We met in Amsterdam. We were both expats. We moved to Hong Kong. I thought for an investment role, I'd end up in New York, and we ended up in Chicago, and we just didn't want to move.
Yeah.
So, I didn't want to I was just ready for a new challenge. And so, we started a family here and said, Chicago is going to be our town. And, it's been great. I think it would have been a lot harder to do the same business if we were in New York or San Francisco, where things are a lot more expensive and the margin of error is a lot lower. But it's still a huge market with a lot of talent and a lot of great universities, great infrastructure. So I feel really fortunate that we've started here. Feels like all of the activities in Sunbelt right now, and we're aware of that. But Chicago's been good to us, and we're happy we landed here to start.
And this is another tough question. I have heard Chicago downtown locations challenging post-pandemic because people were really like, have you had that problem, or has your occupancy been
so
okay?
Again, we feel in some ways we've defied gravity. So we are, running out of space in Chicago. We are not in the Loop, which is the most challenging.
That's an interesting. Is that by design, or is that just like kind of how it happened?
I think it's. I always say it's by design if it works. No, it will. In some ways,
but you're still pretty downtown. 600 West, 306.
It is. So they're bigger floor plates. So in some ways, we weren't going to take, when we were starting, 50,000 square feet. So we started with 15,000 square feet. That is more common in River North and some of these other loft style businesses. Yes. Two, we know our customers, and a lot of them didn't. If you're a tech company that's growth stage, you don't want to be in a
You don't want to go to
big
the loop.
commercial tower that's
Yep.
80 stories. So that was also by design. Early on, we were working with kind of larger local landlords. The Brookfields or the John Buck companies of the time, we were too small to kind of work with them, although that's changing very drastically. So yeah, that's kind of how, partially by design, partially where we were in our life cycle, and then also just knowing our customer base and what they want.
Yeah, and where they want to be. What does your ideal floor plate look like as you open new locations?
Yeah, so we've expanded kind of our square footage that we target, really where kind of the sweet spot is 25 to 35,000 square feet. Minneapolis is just over 30,000 square feet. I would say the true range is 20 to 40,000, but most of the spaces that we're looking at are 25 to 35,000. We like urban, or urban edge. Urban Edge, if you're familiar with Chicago, we have a location in Gold Coast. We could do maybe a Wicker Park type location, but for the most part, we want to be where where there's density, where there's a lot of activity, new company formation, etc. So yeah, that's kind of our focus. And then when we look at expansion, there are certain brands that are more appealing from a takeover standpoint. So we definitely want to have the right look and feel for the companies that are going to be leasing space from us or members of our community.
So what does the expansion plan look like? Is it based on acquisition opportunity, or you have target markets that you're going after?
Yeah, so good question. So, we have capability to do development. We've done it before. We're looking at a couple other locations, but the most capital efficient way for us to expand is, looking at, defaulting operations, across the country. I would say our highest priority focus is in the Midwest, just because we have a lot of brand awareness here and strength. Yep. A lot of our companies, have locations across the Midwest. Okay. A lot of our capital partners invest across the Midwest. So that's kind of where 75-80% of our focus is. And then we have opportunistic deals that are kind of with enormous landlords like my old firm that could take us to the coasts or the Sun Belt, and it's just looking for the right opportunities. I don't want to spread ourselves so thin that we open 6 locations in 6 new cities, and then we kind of lose our special sauce, which is customer focused business services. So we're calculated in how we're doing things, and we're still small enough now that we do a couple 30,000 square foot locations, and it really moves the needle for us. So that's my focus for now. I think that there's opportunities to do much larger kind of portfolio deals in the future. We want to prove our ability to execute across several cities before we start trying to take down 20 or 30 location portfolios.
So is the plan to add additional locations in Minneapolis so that you have kind of a hub or a spoke model?
Yeah. I think, generally when we're looking at cities, we want to go to cities where we could add at least 2 locations, and Minneapolis is one of those markets. We have a beautiful space right on the sky, on the skywalk there that's, got great profile. And, I think let's kind of get traction on that space before we try to move somewhere like the North Loop, Skyway. But I think other locations we like, Columbus, Indianapolis, in the Midwest. And then we've got a lot of opportunities, kind of other cities that you would expect us to be looking at, like Denver and Salt Lake and things like that.
I could look at this on your website, but I'm curious, is your pricing premium, like this layer of, or is it sort of an a la carte, like this layer of business services, and it feels like a higher touch model?
Yeah.
Or is the platform just kind of scalable and enough differentiation that
Yeah, I think we're competitively priced, and we kind of, if you were to evaluate one of our offices, we would be in the same range as all of the other peers. Um, because we're providing the services, we're doing it through outsourced partnerships. So actually, we get the benefit, but without the overhead
The
cost.
overhead. Yeah.
And if anything, it helps our pricing because most of those providers are paying us to be on the platform. So we're able to provide those services at a cheaper price than our peers because, just because of how we've structured everything. Truly, every business that we're doing is asset light. So we're doing management contracts, so we're not taking leases.
Yeah.
We do outsource services. We obviously have a services team to make sure that those are good and that our partners are doing what they say they're going to be doing. And then our venture fund is also an asset light business, which is third party capital. So
Okay.
everything we do has to make sense from a synergy standpoint, has to benefit our target customer, and has to be asset light.
Okay. Got it. Yeah. Interesting. It feels like a smart model because you're trying to keep it sort of capital asset light and yet provide a really differentiated experience, which I think matters a lot these days. Yeah.
Well, I mean, I think, our gross margins are 75-80%, and conventional co-working somewhere 25 to
Yeah.
30%. And
Uh-huh.
just we're taking less absolute dollars, but I
Yep.
think if you are, with those kind of margins, we're able to invest a lot more in the business and a lot more in the services side of the business. So that's the beauty too. I think, we're not putting all of our capital into a build out or, into rent.
Yep.
Instead, we're providing a good customer experience. And I think that generates additional returns for our landlord partners, as well as investors, and well as a great experience for our members.
So I would also guess that your members are less likely to say, I can just do this at home. It's fine. Because are they more team focused?
Yeah, so I think that was by design when we kind of were, my COO and I in March 2020 were like, what the hell are we gonna how are we gonna get everyone engaged? And let's so focusing on how we keep engagement. And it's something that is always a challenge as you start to expand
Yeah.
geographically. But we've already kind of had to do that in the pandemic. So, everything that we built was by design to make sure that we could keep engagement. From a team standpoint and our customer base, the one thing that I think people don't realize about the group that we're targeting is, and if you would have asked me, in 2019, like, hey, pretend there's a global shutdown of commercial office,
Yeah.
who's going to be most impacted? I would say, these venture-backed companies. But truth is, my wife works at a big technology company, and she's in human resources, and they have a ton of infrastructure to do things remotely.
Yep.
Earlier companies don't have that infrastructure or those processes in place. So, communication and getting on the
Right.
same page
Right.
means survival. So
Yeah.
our utilization in the pandemic was way higher than other co-working spaces, and much, much higher than any office kind of conventional office space. And that's just because our companies needed to engage. They
Yeah.
needed to be downtown. They couldn't just work out at Jackson Hole for 2 years and then come back whenever there was a team meeting. So that really played to our advantage. And then we had a ton of organic growth as well. That's the other thing that we benefit from, is that all of our teams are, some don't make it, but for the most part, the ones that were heads down in the
Yeah.
pandemic, they are
They get
5x
funding,
the
they
size,
hire people. Yeah.
and they're growing, and
Yep.
they've done really well. So it's been, we could write a business school case um how companies react to crisis, and kind of the end result of those actions.
Yep. Yeah. But your target market, so I had a space in Palo Alto, which was very different from my space in Chicago in terms of the member makeup. And it was super interesting. People were there because, right, they need to talk to each other, and
Yeah.
they want to do it in person.
Yeah.
And sometimes they had, engineers that were overseas. And then the big flaw I had literally moved and opened the space. I knew nothing about the market, was that once they got funded, they needed more people and they needed more space, which is also a great model if you're selling space
Yeah.
and selling, they loved it. And I didn't have any more space. So
Yeah.
I just didn't know. And I wasn't, speaking of business school cases, and that's
Yeah.
part of the reason I do what I do, because I made, so many mistakes in not understanding that early on.
Yeah.
But yeah, it's a great market, and I love focusing on people who need to be together. So,
Yeah.
interesting. So, just gonna eyeball my list of, have there been any, I mean, you just opened in Minneapolis, but speaking of moving to new markets, any surprises or anything that's harder than you thought it would be?
Everything is harder than you think it will be before you start going to business.
Nobody would do it if
Oh
somebody, if
my God.
they really knew.
You're either naive or crazy. And I was definitely naive. Nobody knows how hard it is to build a brand and get the word out there. It takes a lot of effort, and there's a lot of thankless jobs along the way. And still, I dig too deep into things that I probably shouldn't be digging into, but
That
it's
the
important.
analytical part of your brain that can't,
Exactly. But I mean, just operational, like we did this, why do we do this? Or, and just the coaching part of it. So along the way, you know, there's just new challenges. It's like having a child, right? It doesn't get easier, it just gets different.
different. Yeah.
And it's that's the same with the business now, trying to make sure that everyone's on the same page, and leading with principle, not just rules, is I think something that we've learned.
Yeah.
Customers always right, and instead of like policies, and we're learning stuff like that as we go. And early on, it's people join you because they believe in what you're doing and they're excited about the the dream. And then you start getting more operationally focused, and you have a whole new batch of people, and then getting those people to work with each other. And so there's all of the challenges of building a business. But anyone who's listening to this who's done it knows all about those headaches. And building a co-working business is no different than building a SaaS company, or you name it. So
yeah. Is it harder to find landlord partners out of Chicago?
I would say no. I mean, can't remember what I said. So when I was early on, I think, like I said before, the question was like, how are you going to get people? How are you going to get landlords on board for this?
Yeah.
And now really they're coming to us. I mean, we've got the big Batman symbol up in the sky, and saying we're looking for locations. So we've got a lot of groups coming to us saying, hey, would this work for you? With this, how would this asset be? So it's a nice change of pace. And we're talking to some really major landlords. So pretty much all the names that anyone would know, we're having conversations with. So not really. We're able to be a little bit more selective now, which is a nice change of pace.
Yeah. No, and right. And that's kind of a silver lining of the pandemic. I mean, years ago we talked about management agreements, and that was the big challenge, was like, well, the landlords don't self-identify. So you have to sort of show up in a market and go knock on doors and have very long conversations that might last for 2 years and never go anywhere. So yeah, that's it's good to hear that indicator. Okay, so
and I will say that some of our peers, I mean, the world understands now that the next generation of flex is going to be management. It's the only way this works. So we have some peers that are also educating landlords. We do things a little bit different. We're not trying to do their structure. They're not trying to do our structure. But I think that makes for a better conversation, where it's not like, hey, we're not going to pay any rent, and
let me introduce
this that's like
thing.
they kind of So and it also helps now that we have operational track record. Hey, look, these are the kind of returns we've generated in a pandemic. That just makes the conversations a lot easier.
Yeah. So are you excited about the recession? I wonder
Yeah.
if because of your, niche, like lots of new
Yeah.
businesses start post,
So
because I
never.
was thinking you probably don't. Lots of operators, like an Industrious, is like, we're just waiting for the enterprise customer to show up, right? Like
Yeah.
that's their tidal wave of demand, but that's
Yeah.
not yours. So I wonder if you're maybe less than or more than others thinking this is an opportunity.
So, you never want complete carnage.
Yeah.
I've been trained on the investment side to know that when there is carnage, there's great opportunity.
Yeah.
So I do think that, I mean, the capital markets are essentially frozen.
Yeah.
Reserve requirements are up. So even, asset-backed vehicles are having trouble getting debt financing, and that's causing a huge traffic jam, which means that it's going to be hard on our landlord partners. I think that there's going to be there's a lot of legacy baggage from groups in our sector that were expanding really rapidly, not knowing that a pandemic was coming, or the following kind of financial traffic jam. So I do think that there's opportunities for us. I can't say I'm like thrilled. I think, we do feel a little bit, we're braver than we were. I mean, we went through the pandemic and we grew all through the pandemic. So the team does have this kind of view, like we can handle
You can
anything
do
in the
anything. Yeah.
session.
Bring it on.
But I do think it's a great opportunity for us to expand. And I look at where some of our public peers debt is trading right now. And I see opportunities of more restructuring and stuff. So, we got to focus on what we do well. We got to continue to, service our customers and build infrastructure. And then we're going to be opportunistic and use the market to our advantage where we can. And, I think that means expanding a footprint and, on the cheap.
So what if you look out 5 years, what does it look like for Workbox?
Yeah, 5 years feels like an eternity.
I know.
How
about 3?
I have to do this, outside financing. I mean,
Yeah.
we're shooting for IPO. I mean, I didn't leave Brookfield to be 4 or 5 locations, to be Midwest dominant operator. We really want to build this to something that is, top 5 national operator, and and are always shooting for an IPO. I think that we're going to become very interesting to commercial brokers. CBRE took a 33% stake in Industrious. There's a lot of big groups that have not. Landlords like Brookfield and Blackstone, as they look to address kind of space issues.
Brookfield's been kind of like,
yeah, they're and I have enormous respect for my old firm. They do things, they're very calculated, but when they come in big. So, I think that there's opportunities there, or just, we're different from a brand, and we're also different from a fixed cost standpoint. So we could be a takeout from one of the larger operators as well. The Marriott model, kind of a family of brands.
Yep.
We work, investing in Common Desk and keeping the Common Desk name shows that there's value to kind of that brand differentiation. Obviously, IWG has Regis and Spaces. So I do think as we start to see more segmentation, that makes us interesting as well. But I grew up in investments, and I know we never take an exit as our backup plan. We're going to keep trying to take as much market share as possible and keep growing and keeping our foot on the accelerator. And if for some reason we don't grow the pace that our investors like, then there are options.
Yeah. Awesome. Thank you for taking the time, especially when you have your week old in Minneapolis, and sharing your story. And I always love to talk to somebody who's in Chicago. It's such a great city. Although this is the time of year when I'm fairly happy to not be in Chicago. So in April, I actually there's a co-working conference that's coming to Chicago in April, called Juicy. Yep. And I don't know. I think it's at the Convene. I'm assuming. I can't remember if that's something I heard or if it's on their website.
Yeah.
But anyway, I bought a ticket. So, I was like, April's kind of dicey. That could be puffy coat weather still.
100%.
But we'll take the risk. So anyway, they'll attract a bunch of operators to the city, which will be fun. So
Yep.
anyway, thank you. And I look forward to following your journey.
Thanks so much, Jamie. Thanks for taking the time.